Thank you, Chris, and hello, everybody. Thank you all for choosing to spend some of your valuable time today joining us in this webinar. I look forward to going through today's curriculum, but want to make sure that you get a good value for your time. So today, as we go through the financial analysis, I just want to explain that I've spent the last 25 years performing reserve studies, bringing clarity to the capital budgeting challenge of community associations. This is me. I enjoy speaking in front of groups, sharing hints and tips to make the subject of reserves easier to understand. But today I can't see any of you, so we've got to do a few things slightly differently than if we were in a room together. I expect you've joined us to learn more about the computational side of reserve studies. So if you have a question now, if you've come in with a specific question that you want answered, or at any time during the session today, please type it into the questions box that you'll see on the right-hand side of your screen. It looks something like what I'm showing on the screen here. And periodically, I'm going to ask for some feedback to make sure that you're with me on a particular point. So I'll ask you to raise your hands in response to a point I've made. And that raise your hands icon appears just like this. So let's give that a test. Welcome, everyone. And let's give me a hands raised to show me that you're with me. Great. I can see your hands coming up. Joseph, are you finding it? Mike? Excellent. Okay, I'm going to put your hands down and move on. So to start, I want to make sure that we all back up a moment from the specific topic to gain the right perspective and remind ourselves that the goal here, the overall goal, is to protect and maintain the assets of the association. That's the job of a board member, and it's the job of a manager to help the board accomplish that goal. So we're going to help you towards that goal today by addressing the financial analysis portion of a reserve study. If you're not a numbers person, don't worry. Today I'll go over the subject in a way that you can gain command of the basic concepts. The obstacle we're going to overcome today is confusion. So anticipating your need to know, I'll explain how reserve fund strength is measured by percent funded, what different reserve funding objectives are called, and briefly introduce some of the major reserve funding methods. By the end of this session, you'll be better able to understand what calculations are done in a reserve study and be better equipped to help your association move forward towards a successful future. I believe that when you understand what's going on and why, you're more likely to make a good plan and have it be a plan worth following. What you'll be learning today is all National Reserve Study Standards fundamentals. These standards, which were published back in 1998, almost 14 years ago, give us a stable and consistent terminology, minimum standards about what's to be contained in a reserve study, helpful and key disclosures that are to appear in every reserve study, and a credential for reserve study providers. Anytime I cover a significant National Reserve Study Standards concept, you'll see this blue ribbon NRSS graphic on the page. So to briefly touch on the fundamentals, every reserve study has 3 key results. For some of you, this is a refresher, but let me make sure that we all have this same foundation of knowledge. The first is the component list. It answers the question, what are we reserving for? We were able to spend an entire session on how the reserve component list is created in our Reserve Studies 101 curriculum, now available to view online at your convenience if you weren't able to attend. Today we're going to go through and show how reserve fund strength is computed and how a recommended reserve funding plan is computed based on that reserve component list. The calculation of reserve fund strength answers the question if the reserve fund is big enough for the needs of the association, and based on that starting point, an appropriate reserve contribution rate is computed. In this session about the financial analysis, we'll focus on these calculated second and third results from the reserve study. These same computations are those that we do no matter what type of association, whether it's a big new association, a small older association, or an association with even non-standard assets like the Docondominium Association shown here, an association with no residential or building assets, just boat slips. As a quick refresher, there's a National Reserve Study Standards 4-part test that dictates which components are appropriate for reserve designation. A good and complete reserve component list based on these principles means that you were able to answer yes to all these 4 questions. That the component is a common area maintenance responsibility with a limited useful life, a predictable remaining useful life, and above a minimum threshold cost of significance. The result is a stable reserve component list, something that looks pretty much like this. But the question is, what do you do with this information? And that's what I'll be addressing today. No guessing, no magic, no personal opinions. This is not just the Association Reserves way of doing things. I'll show you how to calculate your reserve fund strength and reserve contributions, all based on National Reserve Study Standards. I'll start out with the question of reserve fund strength. How much is enough? You can see some of the ways people have asked us about measuring reserve fund strength, calculations based on number of units, percentage of the annual budget or unit value, or maybe some cash amounts based on the gut feeling that give you a feeling of adequacy. I think we all know that a large association should generally have more cash than a small association, but how much? Anyway, none of these figures of merits or ways of calculating adequacy are reliable that I'm showing here. So we need to do something better. One key concept that I want you to grasp before I get any further is that a calculation of reserve fund strength is different from and independent from the following up reserve contribution calculations. Reserve fund strength is something that can be calculated and reported as of the start date of the reserve study. It's a now kind of number. You do that calculation and you move on to other things in the reserve study. On the other hand, reserve contributions are plans you make for this year and future years, plans that will affect the reserve fund strength in future years. So the method you use for calculating your reserve contributions that I'll show you today has nothing to do with the calculations for reserve fund strength. They're 2 separate issues. Can I get a show of hands that everyone understands that? Calculating reserve fund strength is different from and independent from your methodology for calculating reserve contributions. Great. Okay, you've got it. Okay, hands down. Thank you. So let's do a test for a few components. How much is enough? Pool furniture with a 5-year useful life and 0 years remaining useful life, meaning it needs to be replaced now. Replacement is projected to cost $4,600. So how much should the association have on hand now to handle that expense? Well, your gut feel probably led you to the right answer. If the project needs to be done this year, you need the money this year. See? No need for a calculator. Let's do another one. A pool resurface project, something that needs to be done every 10 years with 5 years of remaining useful life. So its life is halfway used up. So with a $10,000 projected resurface cost, how much should the association have on hand for this project this year? Well, again, you've probably guessed the right answer. If the component is halfway used up, to be on schedule, you should have half of the money set aside. You don't need the entire $10,000 now. The surface is only halfway deteriorated. What you've seen in these last 2 examples is the concept of the fully funded balance. The fully funded balance is the target amount of funds the association should have on hand based on the deterioration of its reserve components. Simply stated, it's the fractional age of the component multiplied by its current replacement cost. And here is what the fully funded balance profile looks like for that pool resurface project. You can see how the amount of reserve funds needs to grow through the years, gradually approaching the amount that you need to spend. And then once you spend it, it doesn't go away. It just drops down and cycles all over again. So does everyone see how that works? The target fully funded balance grows as you approach the project and then cycles and grows all over again. Show of hands that everyone's with me. Understanding the needs of the association change every year. Great. Thank you, Bill, Celia, everyone. Great. Okay. Thanks. Hands down. Okay, doing the same simple calculation for each reserve component allows you to calculate this year's fully funded balance for the association. For this reserve component list, this year, the fully funded balance, representing the deteriorated value of the reserve components, is a little over $154,000. But the question still remains, does the association have enough? And this is answered when you compare the association's actual reserve fund balance to its fully funded balance. This computation is something you do annually as part of the reserve study update, reported as of the first day of the fiscal year. Like the fully funded balance, it's a simple calculation. It's actual reserves divided by the fully funded balance multiplied by 100, so it's expressed as a percentage. So by now you get to gain some perspective. If this little association had $308,000, they'd be 200% funded. If they had $154,100, they'd be exactly 100% funded. If they only had about $77,000, they'd be 50% funded. You start to get the picture here. Now you begin to see how you can gain some meaning about how much cash the association has each year compared to its reserve needs. Cash is clearly an absolute measurement. It's dollars. But if you want some meaning, something that answers the question, do we have enough, you need to know both how much cash the association has and how much it needs. Percent funded reliably provides that relative measurement, comparing how well the association's reserve funds matches the needs of the association at that particular point in time. Two different associations may be of very different size and may have a very different amount of cash in the reserves, but if they're both the same percent funded, their reserves are comparable in strength. So percent funded is how you measure and report, do we have enough reserves? Cash doesn't provide a good basis for comparison from one association to another. But those are still just numbers. What's good and what's bad? On a scale, 0 to 30% is the weak range, where there isn't much cash compared to the needs of the association. And on the other end of the scale, the 70 to 130% range is where the reserve cash approximately matches the association's deterioration. And in the middle is the 30 to 70% fair range. Here's the answer to the question why these ranges are labeled strong, fair, or weak. What we see is that associations in the 0 to 30% weak range regularly experience special assessments and deferred maintenance. Those reserve cash flow problems are common. In this range, due to their reserve fund being only a small fraction of the association's needs, the association runs into a critical reserve cash flow problem about 37% of the time. That means a little more than once every third year they're in the 0 to 30% range, they'll have a cash flow problem like a special assessment or some significant deferred maintenance projects that they don't have enough money to take care of. On the other end of the spectrum, above 70%, you can see that special assessments are rare. So it's all just a risk analysis issue. When the reserve fund is strong, there's a low risk of special assessment. But when the association has a weak reserve fund, there's a high risk of special assessment. Special assessment risk can be measured and controlled. It's not random. And percent funded is how you measure your special assessment risk. So if you want your association to regularly have enough reserves on hand to do your reserve projects on time, like this rec room bathroom that was recently remodeled, and not worry about tight cash flow, you should aim for a strong reserve fund. The alternative is having a weak reserve fund, meaning that there will be times the association doesn't have enough cash to do the reserve projects that need to be done. Associations with good intentions but not an effective plan end up having a rec room bathroom that looks like this. They of course hoped to have enough money, but when it came time to do the project, they didn't have the cash. They couldn't pass a special assessment and ended up with a bathroom that looked like this. Now, if you're wondering how your association might compare to others, here's the percent funded rating taken from about 10,000 of our clients. You can see that most associations are in the middle fair range, with plenty others both in the red weak range and plenty in the green strong range. It's a mistake to think that all associations are in the weak range and that no association could ever afford to be well funded. Can I get a show of hands to you for those of you who see where you fit on this chart? Great. Thank you. Show of hands. Excellent. Thank you all. I'm going to put your hands down. That's the national spectrum. Most associations are in the fair range. Now, I think you're ready to shift to the second set of computations, calculating the reserve funding plan. National Reserves Day standards require every funding plan be based on 4 principles: providing sufficient cash for the needs of the association, creating a funding plan that's stable and fair through the years, one that's evenly distributed across the ownership base, current owners and future owners, and a plan that's fiscally safe and responsible. So let me say this right up front. A plan based on wishful thinking is not a plan. And let me clear up another myth. Interest does not offset inflation. Interest is only earned on the small amount of reserves in the bank, while inflation grows each year based on the total value of every reserve component. They'll never offset each other. The effects of inflation will always be much larger than the effects of interest. The 3 most common ways reserve contributions are set across the country are the head in the sand method, straight line method, and the cash flow method. And I'll go through those one at a time. I'll describe the head in the sand method only so you can recognize it and avoid it. The head in the sand method is just a matter of an association figuring out their income, subtracting their expenses, and calling the leftover reserve contributions. It's actually a bit of a stretch to call it a reserve contribution method, but on an annual basis, it continues to be, unfortunately, the most prevalent way reserve contributions are established across the country. No wonder there's so many special assessments out there. Done this way, there's no sense of any planning ahead or trying to provide adequate reserves for the future of the association. So it's not a matter of if, but when these types of associations will run out of money. They often tell us they figure they'll just deal with it at the future with a loan or special assessment. But there's some pretty clear problems with relying on these 2 options. And let me show you some real numbers. Let's talk about a $250,000 15-year re-roofing project. If the association sets money aside through regular reserve contributions, even with just the little interest that you're earning today, the association will have about $250,000 after only contributing about $230,000 due to the magic of compound interest that the bank is going to provide. That means you're able to pay a $250,000 roofing bill by only putting in $232,000 of your own dollars. That's really pretty neat. Budgeted contributions are clearly the least expensive way to fund a reserve project. On the other hand, if the association needs a last-minute special assessment, they'll need $250,000 collected in a special assessment to pay that $250,000 roofing bill. But if they take out a loan, in addition to paying the $250,000 principal back to the bank, they'll pay some significant interest, paying out a total of over $320,000 for that $250,000 roof project. The lesson here is that things get very expensive when you don't plan ahead. And here's those same numbers shown graphically. The cheapest way to pay for the reserve needs of the association is always budgeted reserve contributions, period. As unpopular as that might be, it's the truth. Special assessments and loans are an expensive way to pay for reserve projects. And remember, there's no guarantee that your homeowners will approve the special assessment. And if they don't pass that special assessment, the association may end up having some significant deferred maintenance, something that has the unfortunate side effect of dropping property values. So in summary, the head in the sand method is an overall bad idea. The straight line method is seemingly simple in concept, but it has some very real complexities when you try to apply it to a real situation. That's because it's clumsy and inflexible. It points an association towards full funding, which is a good outcome, but it does so very rapidly, which results in high reserve contributions that are difficult to fit into your budget. So that's bad. And in addition, it results in irregular contributions through the years, so it lacks fairness. Excuse me. So the straight line method does not meet the 4 National Reserves Day standard funding principles very well. I'll be able to spend some more time explaining this in our Reserves Days 103 webinar. The cash flow method is powerful and flexible. It too has obvious flaws, which primarily have to do with being used inappropriately. And this is the consequence of this method being so flexible. Even bad results can be computed. Using this tool does not necessarily put the results into the category of good. Results with this method are often a reflection of the user's skill, not the innate value of this contribution calculation method. But that's the key point I want to make. It's more important to focus on what you want to accomplish. Tools like the cash flow method allow you to accomplish any objective. You need to know your choices, and you need to make a good choice about objective. So I'm going to stop my discussion about methods. It's more important to choose and focus on your objective, what you're trying to accomplish for the association, the goal, rather than pledging allegiance or choosing between methods. So let's focus on funding objectives. How strong do you want your reserve fund to be? Is yours a conservative or an aggressive association? Or in other words, how tolerant is your association of special assessment risk? National Reserves Day standards clearly define 3 funding objectives: full funding, threshold funding, and baseline funding. These are the things that you should be selecting. Full funding means the conservative objective of having the goal to be 100% funded. Baseline is the other extreme, which means having the goal to just barely have your reserves be cash positive through the years. Threshold funding is a strategic choice of a particular dollar or percent funded target, typically somewhere in between the 0 baseline or 100% full funding objectives. So when you're focusing on objectives, when you focus on results, then what you find out is it's best to use the calculation method that's absolutely transparent, the method that allows you to accomplish whatever goal or objective the association chooses. That means using the cash flow method. So remember, I'm not praising the cash flow method for its inherent value, other than it allows you total flexibility to approach and attain the goal that you want to choose. So follow with me as I illustrate 2 examples what I'm talking about here. This is with both of these examples will be with the sample reserve component list I showed earlier. Here I'll use that cash flow method to achieve 2 very different funding objectives. The first thing I'm going to do is design a funding plan that keeps the reserve fund cash positive through the years. As I mentioned before, this is called baseline funding, and the cash profile through the years will look something like this. I got this by testing some different contribution rates until I found one where the reserve balance never goes below 0. Notice how the reserve balance jumps all around, dropping close or low, close to 0 or low after a large project. So the question is, what's wrong with this? What's wrong with creating a plan to always have enough reserves for your anticipated reserve projects? Here's the answer. Here's the same baseline funding plan, but now I plotted it on the basis of percent funded instead of cash. So this is a baseline funding plan just plotted on a percent funded basis. When you look at it this way, you can see there's many years when the association's reserves are in the 0 to 30% weak range. Can you count up how many years? I get about 9 or 10 that they're in the red zone. And if you recall what we discussed a moment ago, moving forward on this plan will mean that there's, with a 1 in 3 chance of a special assessment any year you're in the red zone, will mean that this association will be faced with about 3 special assessments while they're in those red zone years. And now I'm going to show you another example. Same association, same component list. All I've done here is adjust the contribution rate a little higher. This allows the reserve cash balance to grow through the years. And note that there's a healthy reserve balance. It never gets close to 0 as it did with a baseline objective. But the question is this enough, or obviously is it too much? Why would you ever want this much money in the bank? And again, to provide some more insight, I've plotted that same information on a percent funded basis. Now, looking at reserve fund strength, you can see that this association gradually approaches the 100% funding level. That's why it's called a full funding plan. And remember, we use the cash flow calculation method. And note here how this association with this funding plan never spends any time in the weak zone, so it's never at a high risk of special assessments. And that high reserve balance, it's exactly what we agreed earlier, felt right, just offsetting the deteriorated portion of the reserve components. So to summarize reserve funding, pursuing a full funding objective points association towards a low risk of special assessment, while associations pursuing a baseline funding objective enjoy a slightly lower reserve contribution rate. Those associations have a significantly higher exposure to special assessments. There's really no escaping reserve expenses. Either you pay for them with ongoing contributions, or you pay for them in the form of a special assessment. You have a choice. Now you might wonder how any association can afford a full funding objective. The answer is, on average, full funding contributions are only about 13% more than baseline funding contributions. It takes a lot of money to provide enough reserves so there's sufficient funds just to keep the reserve fund above 0. So it doesn't take a lot more to build up some margin, a little safety up to the 100% funding level. Let me say it another way. Baseline contributions are not half of full funding contributions, not even 2/3. Baseline contributions average 87% of full funding contributions. The size of contribution differences between the two is very small. And I'd like to conclude my comments on this subject by illustrating how small that difference really is. While the difference between the aggressive baseline funding plan and a conservative full funding plan may be 13%, when you look at it in view of the association's overall budget, the difference between the two is only about 3% of the total budget. Not a big deal. While I've been able to explain some concepts about the reserve study financial computations, I don't want you to leave with just a knowledge of concepts. I want to give you some keys to success at your association. So, what are the keys to success? It begins with a stable foundation of a current year reserve component list based on National Reserve Study standards. And calculate, learn, and disclose the annual strength of the reserve fund. Know where you are. And follow that up by crafting a plan to a successful future, whether conservative or aggressive. You know what that's now called. Conservative is full funding, aggressive is baseline funding. And finally, make sure you update your reserve study annually. You can't make good decisions or accurate disclosures with outdated information. Reserve issues are simply too significant to responsibly ignore for years at a time. The component list and your reserve balance change and get outdated every year. So what do? You can tackle it yourself. I've laid out the basic concepts for you. It's not too big of a cost or challenge if you have the right background and the right software tools. But obviously we'd like to be of assistance if you'd like professional help. From our network of 10 offices across the country, we can provide you with expertise and experience that helps you get your reserve study updated, and then it becomes valuable, helping you make the budget decisions you need to protect and maintain the assets of the association. And with that, I'll conclude the formal portion of my presentation. I'd like to thank you for joining us today. I hope you feel it's been a good investment of your time. I ask you to check your email each month for a schedule of upcoming live webinars. And at this point in time, I believe we have a few minutes for questions, so I'll turn the floor back to Chris. Chris, back to you.